Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of these patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that.
Chicago soybeans. Okay, so for many months now, I'd started here with my longer term monthly charts, as the market, since as far back as the low seen in August 2024 till October 2025, built a sideways action. I noted this action 63 weeks ago, just over a year ago now, and this sideways action had a breach on the upside in October last year and a second more serious breach in January this year, through March into April and now into May. Prices have now consistently closed and stabilized over the 3-year moving average, currently 11.39 1/4. However, the key feature which I wanted to make you aware of is the bright red neckline, which is currently at 12.16, which you can see redrawn here on my daily chart, a little above the current market. This bright red neckline has been pierced, but not as yet properly broken, and is the key to the longer term action here in this market. Monthly consecutive closes over this bright red neckline will see the termination of a huge December 2020 to January 2024 head and shoulders top pattern. Of all the subsequent consequences, especially on the downside, or should I say the failure to push on down. This is something to keep in mind as we go forward. So coming back to the very recent action, this had seen a small rising wedge pattern formed over April from an earlier sideways action that had even earlier been the exit from a small bull channel. However, we have seen prices break on the upside 3 times in the last 3 weeks and twice on the downside in the last 2 weeks. So, as I said last week, this pattern is compromised, and instead I've looked for an alternative. I didn't have to look far. As we step back just a little bit, we can now see a March to date based very shallow bear channel. That's currently 12.51 3/4 to 12.30 1/4, and that's highlighted in bright green on my daily chart. It is not an ideal pattern, but it does fit in with the recent action, just about. At the moment, the market is midway between the shallow bear channel lines, with some considerable congestion below formed over March and early April between roughly 11.93 to 11.70. Thus, we should have some pretty good support below right now, and some potentially good resistance above, but this overhead resistance can be pierced. We now come to last week's action, which ended up as a weekly key reversal down, but which initially there was no follow-on low at the start of the week. However, this has changed, and prices have moved down to just above the green short medium moving average, which is currently at 11.91, where the market has found some support. This support had been pierced but not broken last week, and indeed the market had made a weekly key reversal down last week as a result of this. However, the initial action was a strong reactionary move back up on Monday and Tuesday this week, but this has dissipated, and we are back down to testing the lows of this week today. This leads me to what is the big consistent picture here, the bigger picture, and in this prices are still well within the dark blue December 24 to August 25 bullish Andrews pitchfork, in between the dark blue middle time above, currently at 12.53 1/2, and a dark blue lower time below, currently 11.34 3/4. This is the key overall pattern, and it has been driving prices higher since August last year. Chicago soybean meal. The market continues moving up nicely from the bright red late September 2025 to mid-January 26 bullish shift pitchfork, specifically between the bright red lower time below, currently at 3.1690, and the overhead bright red middle time, which is currently at 3.4370. This middle time has been especially good at capping prices since late February, though more recently, indeed last week, the 61.8% absolute Fibonacci line at 3.3830 has taken on that load a little. A little below this pattern, we have the significant dark blue trendline extension, currently at 311.30, of the July to September 2021 descending triangle, which had acted as an attractor and then later as a base for the moves higher over late February, March and start of April. Now, we also had the 50% Fibonacci on the May 24 to July 25 move at 326.20, originally capping prices but now seemingly starting to act as a support. This is where what had been a word of caution on my part in the past, but which now is an observation and is worth repeating. I said 8 weeks ago, and I quote, should prices turn back up, especially if we start closing over the 50% Fibonacci line, then the next choice will be the bright red middle tine. But a word of caution, you see the bright red middle tine is now awfully close to the 2025 high at 333.5, and they together may be a stronger resistance than each individually. I suspect any reversal back upwards will very much depend on maintaining what we have seen since the beginning of this year, the low in early to mid-January. We have so far had rising lows, a very definitive bullish sign, and that depends on the market not pushing down below 308.90, and that's the end of the quote. We have continued to see generally rising lows and higher highs. Indeed, seen since the start of this year, bar one single aberration, the market has been caught between the bright red lower time below and the bright red middle time overhead. For now, I will continue to watch this ersatz bull channel develop, especially as prices are now testing that potentially significant resistance, that 61.8% absolute Fibonacci line. This leads me to my final point, and also a word of caution. This commentary would not be complete without my discussing a portion of my commentary which I have repeated here for 155 weeks. So coming up now for 3 years. It is the annual key reversal seen here at the end of 2023. I said back then, and I quote, I now only need to remind you once again of my words when I pointed out that Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023, and we've been living in the shadow of this pattern ever since. End of quote. I've also added ever since, and I quote, if there's only one thing you take away from any of my musings, let it have been those words. End of quote. For nearly 3 years, the shadow of that pattern has darkened the skyline of this market ever since. I continue to wonder. To wonder is actually a more an apt description if prices are now finally exercising that shadow. However, please bear in mind we are still significantly below the close of 2023 at 386 even that was. Chicago soybean oil. There is one pattern here that has defined moves higher this year, but is now being thoroughly tested. It's the bright pink March to August 2025 bullish Andrews pitchfork. The bright pink upper tine currently at 74.29, capping the market most of the time. We had broken up through this pink upper tine 3 weeks ago, but then late last week and then this week we are back below this upper tine, and within the pitchfork pattern, possibly making the push higher only a possible breach that may be in the process of being repaired. Now, this breach higher prompted me last week to draw a mid-March to mid-April bullish Andrews pitchfork, though this also saw a breach higher 2 weeks ago, which has since been repaired. We are now back within this smaller dark blue pitchfork pattern, and interestingly testing the dark blue lower tine, which is currently at 72.35. Thus you could say we are getting caught and squeezed between the bright pink upper tine that is overhead and the dark blue lower tine below that is rising upwards. This leads me to something I spoke about 3 weeks ago when I said, and I quote, what is noteworthy is that we saw the development of an ascending triangle over March and April, but which has now turned out, it seems, to be a bullish halfway hesitation. Last week, so that's actually now 4 weeks ago, last week prices broke up through what seems to be the top of the hesitation part, the halfway hesitation, specifically the congestion between 68.71 to 69.12, and made the March action into the hesitation part of a very large bullish halfway hesitation. This leaves us now, excluding the idea of an ascending triangle pattern, with a few distinct possibilities for the bullish halfway hesitation. Thus, if we measure from the start of February low, then we have a primary target X up in the 75.40 area, so not too far above, and a harder to reach secondary target X1 up in the 82.10 area. If, however, we measure from the deeper December 25 low, then we have a primary target X2 up in the 78.45 area, for harder to reach, much harder to reach target X3 up in the 87.20 area. I'll be interested to see how the market deals with these potential targets. And that's the end of the quote. Well, 2 weeks ago, prices reached the first easy target X at 75.40, but it still leaves target X1, X2, and X3 higher up, still open. I think for this market, the question once again is not whether the market is bullish or not, but how bullish is this market?
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.